The Financial Planner, presented by BSC, Investors Protection Fund.
Welcome back. You're watching Financial Planner. Over the next 30 minutes, Hemant Rustagi, CEO of Wiseinvest Advisors, joins in to talk to us about financial planning and help us take up all your financial planning queries. Hemant, I was just reading an article this morning that said that the Sensex is at 20,000, but retail participation continues to remain very low. This brings me to ask you, despite FIs being so optimistic on India, retail participation of domestic investors is still very, very nervous. Most domestic investors, if they do not invest directly into equities through buying stocks, it's done through mutual funds. And I know we've talked about the advantages of mutual funds, and you can sit here and talk about them for the longest period of time, but it's still not leading to any sort of change in terms of mentality. People are still very apprehensive of putting money into equities through mutual funds. Tell me, what is the big problem, and why are we so scared of mutual funds to begin with?
Well, I think it's rather unfortunate, that a dynamic investment vehicle like mutual fund has failed to actually find a permanent place in the investment universe of investors. And I think there are a lot of reasons for that. In the past, see, what has happened is there have been like mismatch between reality and expectation. Okay, the wrong positioning of funds, maybe a bit of mis-selling, and also the wrong selection of funds. So there are a whole lot of factors that have resulted in a situation today where investors do not really invest in a big way in the mutual funds. Now that is an unfortunate thing, because the problem is, it's not only there's nothing wrong with the vehicle as such, I would say. I think it's a lot to do with the mindset of investors. In India, most of the investors still consider equity to be as a passport to overnight riches. Okay, the fact remains that most of the time the retail investors will come in only when the markets have reached the peak or near peak. That hasn't changed. And what typically happens is, when investors come and invest at those levels, okay, there are two problems that happen. One is you are investing at the peak. Second, you're not sure, you're investing because you want to make a quick buck. You have not come with a defined time horizon, so you're not prepared. You're not prepared to face the volatility that may actually play out over a period of time. And the third is, because you are investing at that level, you have mid-cap funds, sector funds doing very well. And investors have the habit of investing in the flavor of the month kind of investor. So I think in all counts, their experiences have been pretty bad. Now what happens when the markets start falling after that? Investors need to continue the process of investment. And like I mentioned earlier, they're not mentally prepared for this. They don't have a defined time horizon. So every time you've seen this cycle, you've seen a set of investors coming in and going out from the mutual fund totally disappointed. So the result of that is today that equity funds are today equated as investment which is very serious, very, very risky. Of course, equity as an asset class is risky, but we can't ignore its potential over the longer term. But unfortunately, because they go out midway through, they have not experienced the good side of it. Or for example, what we are seeing in the last 6 months or so, the markets have started doing well. Okay, investors are seeing that their NAV levels are rising. They're seeing that the losses are being cut now, or they've started making some money. They have no patience. This is the time they want to exit. So what we are seeing in the last 3, 4, 5 months, only redemptions, no inflows. But thankfully, there is a set of investing in equity fund through SIP. Now these are the guys who actually come in with a defined time horizon. And I'm very happy to see that, because I've been in this market for a long time. What I'm seeing now is that investors are continuing their process irrespective of the market condition, which I thought maybe is a good beginning, that you may see the result in future. But as of today, equity funds continue to suffer because of these factors. And like I said, there is no shortcut. I'm not going to say that this is going to change in a hurry, but I personally feel that it will change over a period of time.
Okay, so investors have gone out there, made their mistakes. They remember those mistakes. What do you do now? You've burnt your fingers, but you learn from these mistakes, right? So how do you get rid of the unpleasant experience and look at the brighter side of things?
Well, I think we talked about the advantages of mutual funds. Okay, we do keep talking about it, but I think again, for the benefit of viewers, let me just remind them that you have full-time professionals managing your money in the mutual funds. Where else can you actually get service of the best fund manager by just investing 5,000 rupees or 10,000 rupees and buying 2.5% or 3% as a cost over a period of time? So my belief is that mutual funds have a lot to offer in terms of professional fund management. There are regulations in place, which means that there is a complete transparency. The investor's money is safe because the regulator see as to or decide what mutual funds can do or what they can't do. Mutual fund also happens to be one of the most tax efficient investment vehicle. Okay, so for the taxpayer, I think there is a clear tax arbitrage, a great benefit for them. And even for the non-taxpayers, the The myth is that mutual funds are meant only for taxpayers. I think that's completely wrong. As we discussed earlier, mutual funds have the potential to perform, and mutual funds offer much more than equity. There are gold funds, there are debt funds which investors need to look at, not just the equity fund. The second point is that whenever there is talk about SIP, the only fund investors look at is equity fund. Now, they need to be very careful here. What they need to look at is they look at their time horizon. For example, someone is investing for 2 to 3 years. By all means, invest through SIP, because SIP is a mechanism that allows you to build a corpus over a period of time. But look at the right kind of fund. Look at debt-oriented hybrid fund like MIP. Look at a balanced fund. You don't have to necessarily invest in equity fund. So if you select the right fund, I think you can gain a lot from equity as an asset class. Then I mentioned about gold. For example, gold has to be a part of the portfolio. Of course, one has to be careful in terms of how much exposure you have to the gold. But gold in mutual fund provide a great option. You have gold ETFs, you have gold saving fund, now which are not only convenient. A small investor can buy even 1 unit if they like. So I think it's a great option, and also it's more tax efficient. On the debt side again, in the falling interest rate scenario, there are different kind of debt fund which can provide better return than a traditional option. So I think it's time for investors to look at mutual funds differently as compared to what they have been looking at in the past. Do not equate mutual fund only with equity. They have much more to offer. Select the right fund, and then you can benefit a lot from this wonderful investment vehicle.
One of the key aspects to gaining or making optimum returns is diversification. But a lot of investors make the mistake of over-diversification. How do you avoid over-diversification? What really happens when one over-diversifies?
Well, in today's uncertain markets or times, diversification is the key to investment success. But also, unfortunately, this is also one area where a lot of investors make the mistake. And I'll tell you the reason for that is because the common belief is the more number of stocks you have in the portfolio, the better it is. The more number of fund that you have, the better it is. I think investors need to realize that when you invest in a mutual fund, it's a collective investment vehicle. It's a diversified investment vehicle. Every equity fund, for example, will have 40 to 50 stocks. Imagine if you have 20 funds in your portfolio, you'll actually end up having 5 to 600 to 700 stocks in your portfolio, assuming that there are going to be common stocks here. Now, you cannot have a stock portfolio wherein you're investing in 700 companies. What investors need to realize that when you have an over-diversified portfolio, it starts affecting your performance. And the reason for that is the non-performing fund will pull down your performance of the better performing ones also. The portfolio becomes very complicated. It is always difficult to monitor a complicated portfolio. So I think what they need to do is keep it simple. Of course, there is no optimal number of fund that you can say that, okay, I should have 8 or 10. It all depends on your time horizon, the kind of investor you are,
the amount of money you have.
I think one caution here, every time when you look at large number of funds, it should not be declared as an over-diversified portfolio. For example, on the debt side, you have an ultra short-term fund for the money to be parked for some months. You have a short-term fund if your time horizon is 6 months to 12 months. Then you have income fund if your time horizon is 18 months to 24 months. You may have some FMPs in your portfolio for 3 months, 6 months, 1 year or 5 years. Now that is not over-diversification, because the major differentiation, as I mentioned earlier, is the time horizon. So I think that is not over-diversification. Over-diversification is when you have 5 ultra short-term fund, when you have 5 income fund. That will be over-diversification. Right. So I think there are a few things that investors need to do if their portfolio is suffering for over-diversification. One is they need to weed out the non-performing fund. The second is if they are similar looking fund or the fund with similar objective, they need to reduce the number there. Third is rebalance the portfolio. That will ensure that the number of funds remain in proper control. So I think if they do this, if they ensure that the portfolio is not over-diversified, they can actually enhance their performance over a period of time. And also they'll find it easier to manage the portfolio.
There's nothing like a freelance. Everyone's got to take on some risk in order to be able to make some optimal returns. But of course, risk tolerance is the key to investment success. How do you determine that you're not taking too much risk or not taking too little risk, so you're maintaining the right balance of risk while you're trying to make those returns?
You're absolutely right. See, risk tolerance is very, very important. Many a times investors make the mistake of looking at only the return. 2 things that they ignore is, one, how much risk they themselves took to get that kind of return, and how much risk the fund manager took
to get those returns.
Give those returns. So a good return is only when you earn healthy return by ensuring that the portfolio remains within your comfort zone. So the first point here is you need to define your comfort zone. 2, you need to look at basically what your time horizon is. Once you go by time horizon, automatically the risk profiling is done. Like for example, if you're investing for 15 years, there you can put the money in equity. If you're investing for a short term of let's say 1 or 2 years, that money goes into debt funds. Right. So automatically the time horizon will help you. Third very important thing is that you need to reassess your risk profile once you have defined it, every year. The reason for that is your personal situations may change or the market conditions may change. Sometime, even though it's not a great idea to change your portfolio depending on the market mood, but sometimes it makes sense to realign your portfolio. So there are 2-3 factors, like I said. Define your comfort zone, go by your time horizon, and keep reassessing your risk profile. I think you'll always ensure that you never step the line of where basically you draw a line for yourself saying I should not be taking more risk than that.
We'll take a break on that note. We'll come back and take some of your financial planning queries, so stay tuned.
The Financial Planner, presented by BSC Investors Protection Fund. Financial Planner, presented by BSC Investors Protection Fund.
Welcome back. You're watching Financial Planner.
Investment Ladder, presented by BSC Investors Protection Fund.
Hemant, just taking a cue from a previous discussion of over-diversification, and we've got a query that pretty much highlights that to a very great extent. Kanchal Sharma writes into us, she's 34, her monthly income is about 1,10,000. Her goals are as follows. She needs 51 lakh rupees in 18 years for her first child's MBA, rupees 42 lakhs in 22 years for the child's marriage, 67 lakhs in 22 years for the MBA of her second child, almost 60 lakh rupees in 26 years for the second child's marriage, and about 4.6 crores in 30 years for a retirement. She's got the following investments per month: 500 rupees in Reliance Gold Savings Fund, 1,000 rupees in Reliance Regular Savings Fund, 1,000 rupees in Reliance Pharma Fund, 500 in Reliance Banking Fund, 500 in ICICI Pru Tax Plan, rupees 500 Fidelity Tax Advantage, 500 in HDFC Top 200, 1,000 rupees in HDFC Prudence, 1,000 rupees in HDFC Equity, about 2,000 rupees in DSP BlackRock Top Equity, about 1,000 in IDFC Premier Equity, 1,000 in SBI Blue Chip, 1,000 in PSL Dividend Yield Plus, and she pays 60,000 as premium for various ULIPs and endowment plans. She's got no other savings or assets. Will she be able to achieve those goals?
Well, let me begin with good things first here. The right way to start your financial planning is to establish your goals. You need to assign a time horizon for each one, set a target. And I think as far as this is concerned, Kanchan has done a great job there. She's defined her goals, time horizon, everything has been done. Now, before we go on to discussing the over-diversification in the portfolio, let's see how she's going to be achieving her different goals. She's basically mentioned about 5 goals here. Now, 2 important things here. The minimum time horizon is 18, the maximum is 30, which means that the time is long enough at her disposal to be investing in an asset class like equity. So she should be focusing on well-diversified equity and maybe some exposure to gold fund there, because there is enough time here. Second is, because if the portfolio is going to be in well-diversified equity fund, I'm assuming a return of 12% there to find out how much she needs to invest for each of these goals to achieve her goals. To begin with, I think the first goal that she has is the higher education of the first child. The time horizon is 18 years and the target is 51 lakh. She needs to invest 7,000 rupees to achieve this goal. Of course, because all these goals are different, and 2 things again she needs to remember. One is to create a separate portfolio for each goal. That helps because then you are in complete control of what is happening. Second is, because you have defined the time horizon, you need to continue investment in this process irrespective of the market condition. So as far as second goal is concerned, there is the marriage of the first child. There the time horizon is 22 years. Right, and I think the target is 42 lakhs. She needs to invest around 4,000 rupees per month. The third goal that she has is the higher education of the second child. There the target is 67 lakh. She needs to invest around 6,000 rupees per month. And for the fourth goal, which is the marriage of the second child, she needs to invest around 3,000 rupees. Fifth goal that she has is 30-year time horizon. She needs a corpus of 4.6 crore, for which she needs to invest 15,000 rupees per month. So in all, she needs to invest around 35,000 rupees. Currently, she is investing 10,500 in 13 funds. As we discussed earlier, this is clearly a case of over-diversification. I think you cannot have so many funds for investment of 10,500 crores. So I think there is a clearly need to realign the portfolio, rework on the portfolio. But if she continues want to enhance her investment to the total 35,000 that we mentioned, then maybe the number of funds are all right. But if she's not going to increase the investment amount, then she needs to really bring the performance down. There are 2 sector funds over there. For someone like her, should not be looking at sector funds. So I think maybe to begin with, she can actually, take the money out of those sector funds. So this is how she can achieve the goals. But there are 2 important aspects again she needs to look at. One is, the risk management. Risk management basically in the form of life insurance cover and also the health insurance. She needs to make sure that all the earning members in the family, because I believe that she's talking about a family as a whole, are adequately insured. There, she can apply the thumb rule that the insurance cover should be 10 times of the annual income. The right option would be to go opt for a term plan. They have a number of ULIPs and the traditional insurance policies there. I don't think these are the policies that will give them the kind of risk cover they need. So I think there is definitely a time for them to review this. Even if that means they need to book losses and some of them stop that and direct that money into mutual fund after ensuring that they have adequate risk cover by way of term plan. I think that will actually work in their favor because, as I mentioned earlier, the minimum time horizon is 18 years and goes up to 30 years. So if somebody has made a mistake, if she has made a mistake in terms of allocation, she should rectify that now rather than continuing with it for the next 18 to 30 years.
Right, that's the advice coming for you, Kanchan. We'll take a quick break. We'll come back and take some more queries, so stay tuned.
The Financial Planner, presented by BSC Investors Protection Fund. Financial Planner, presented by BSC Investors Protection Fund.
Welcome back. You're watching Financial Planner. Hemant, we've got a query from a senior citizen who writes and says one of their close relatives has lost her husband and now is solely managing her family affairs. On the death of her husband, she's received a lump sum amount of 40 lakhs from PF, gratuity, etc. In addition, her annual income from pension of her husband and her job is around 5 lakh rupees per year. She has 2 dependent school and college going children and does not have any other liability like in home loan, etc. What does she have to do? She doesn't even need this lump sum money for the next 5 years. Since the annual income is sufficient for her daily expenditures. In 5 years, I guess she needs it for a child's education and marriage.
I think 2, 3 good things that I think they mentioned clearly is one, I think she's looking at going for a term plan, and also in terms of health, she's looking at basically a floating rate, floating health insurance plan, which I think is the right decision to take. And I think there is also a recommendation for, or maybe there's already investing in SIP. In some large cap oriented fund, which is perfectly, I think, as far as these 3 things are concerned, I think she is completely on track.
Right.
I think the sizable amount of the portfolio is invested in, in the fixed deposits. I believe that is one part of the portfolio where she needs to make a change. But I think the important factor to remember is that this 40 lakh money which has come is a one-time corpus. This has to remain intact and also has to grow at a healthy rate to ensure that all her requirements or all her goals are achieved without risking the principal which is there. So I think what can be done gradually is some money can go into debt funds of mutual fund. Right. It could be short-term fund. It could be like in the current scenario, I would say maybe look at some dynamic bond fund, and also a significant part can also go into monthly income plans. Now these are the plans which are hybrid funds. Invest 80% in debt and 20% in equity. Because we have to restrict the equity exposure, I believe that this is a good product for them. So I think gradually what needs to be done is move some money out. Of course, the money should remain, a part of money should remain in the fixed deposit also. Should not move into market-linked product. But some part of it definitely can go into income fund as well as debt-oriented hybrid fund. I think as a combination, it will ensure that one, if there is a need of regular income, that can be taken care of. 2, the principal would by and large be safe. And 3rd is the money can grow at a meaningful rate, which can take care of inflation over the longer period.
Right. Hemant, we've got one query from Nilesh, and he says he's working for a private company. He's 46 years old, wants to retire when he's 60. He's opened a PPF account in 2005 for himself and his wife. And the balance in that is about 2.5 lakhs. He wants to invest 15,000 per month at the present cost of both his wife and himself after retirement. Recently, he's come across a new pension scheme. His question is, shall he continue with the PPF account? If so, for the balance period, how much amount should he deposit in each account per year to get the proposed income as mentioned? Shall he continue the PPF account with a minimum deposit of 500 per year and open an NPS account instead? Instead of PPF and NPS, shall he start investing in mutual funds through the SIP route? What is it that you have to tell him? And of course, he also says he can invest in pension ULIPs if you suggest that.
Well, I think before we discuss what are the right options for him, because obviously looking at retirement planning, what we also first need to look at is what will be his requirement when he retires. I think it's a time horizon of 14 years from now. Now, he's mentioned that, his expenses are going to be, as per the current cost, around 15,000 bucks. Now, if I take inflation into account, 7% for the next 14 years, I think what he will need at the time of retirement is around 39,000 rupees. To create that, basically, he will need a corpus of 67 lakhs.
Right.
Now, to create that corpus from now on, he needs to invest 19,000 rupees because he's mentioned that he's not very, investor who's very aggressive. I'm assuming a return of around 10% from the portfolio. So he needs to invest around 19,000 rupees to create this corpus. First, he needs to focus on that. He's mentioned about NPS. NPS is definitely a good option. But my view is that if he looks at well-diversified equity fund or a balanced fund in the mutual fund space and continue investing in that with investment in PPF. PPF is the best investment on the debt side because the return is risk-free, tax-free, and also attractive. So I think as a combination of this will be better than having NPS as well as the PPF.
So it's PPF and equities is what you're...
Yeah, I think that will be a better option.
Investment Ladder, presented by BSC, Investors Protection Fund.
That's also all the time we have on this edition of Financial Planner. Thanks for watching.
The Financial Planner, presented by BSC, Investors Protection Fund.